Meet Jake. He's 25, pulls in a very respectable $60,000 a year, and yet every single month he feels completely broke. To understand why, we have to look at what money actually is. Thousands of years ago, if a wheat farmer needed milk, but the milk farmer didn't want wheat, trade ground to a halt. Money was invented as a temporary placeholder to bridge that gap, a tool designed for easier exchange, not as a permanent destination for value. We see the reality of this play out all the time when high-earning athletes and lottery winners suddenly go bankrupt. Earning millions of dollars means nothing if you confuse a large paycheck with actual wealth. Look at this pipeline. Income is the raw volume of capital flowing into the reservoir. Wealth is what actually stays in the tank after your expenses drain out the bottom. You can pump $300,000 a year into this system, but if $310,000 drains out, you're simply broke on a larger scale. The wealthy build side inlets, assets like index funds and rental properties that pump new capital into the reservoir. Most people, however, buy liabilities. They finance cars and accumulate consumer debt that puncture large holes in the tank, draining the capital faster than it can arrive. Obsessing over the size of your paycheck while ignoring the leaks guarantees financial fragility. Your ultimate security relies entirely on how strictly you govern the outflow. Controlling that outflow starts with fighting human psychology. When you tap a card or use a digital wallet, the physical pain of handing over cash disappears. Your capital quietly bleeds out of the system because the friction of spending is completely gone. Then there's the monthly payment trap. Dealerships don't ask if you can afford a $50,000 car, they ask if you can swing $650 a month. Breaking purchases down into bite-sized installments camouflages the devastating total cost of consumer debt. To stop the bleeding, you need a mechanical routing system. This flow diagram illustrates the 50-30-20 rule. Your main cash flow hits a junction and splits. 50% gets routed to mandatory needs, 30% goes to lifestyle wants, and the crucial final 20% is aggressively trapped for saving and investing. That 20% channel flows directly into the base of your savings pyramid, the emergency fund. This foundational layer serves as a defensive shock absorber, holding 3 to 6 months of living expenses to ensure the rest of the system remains stable during a crisis. Once the base is locked, the flow rises into short-term savings and finally long-term investing. Building this structure backward is a disaster. If you invest heavily but ignore the emergency base, a single medical bill forces you to sell your investments, and the entire structure collapses. Wealth is determined by the percentage of capital you aggressively trap and protect, regardless of the gross volume you earn. But sitting on trapped capital isn't enough, because your money doesn't rest safely inside a vault. Banks are businesses. When you deposit your savings, you are simply providing them with raw inventory. This dynamic is called fractional reserve banking. A bank keeps only a tiny fraction of your deposit on hand and loans out the rest. That loaned money gets deposited into another bank, which loans out a fraction of that, creating a massive branching chain reaction of new capital across the economy. The master control room for this entire multiplication process is the Federal Reserve. The Fed manages the system using interest rates as a giant macro valve. If inflation runs hot, they raise rates, making borrowing expensive and slowing the economic flow. When growth stalls, they lower rates, making money cheap and accelerating the flow of spending. You interact with this system through debt, also known as leverage. Using leverage to finance a luxury car is a fast track to financial ruin, but using a mortgage to control a cash-flowing rental property allows you to amplify your wealth using someone else's money. The wealthy understand exactly how these banking mechanics work. They use leverage to intentionally route the economic flow toward their own assets, while the uninformed are simply swept away by the current. The final destination for your protected capital is the stock market. By steadily pouring money into diversified index funds, you capture the collective growth of hundreds of companies, allowing your wealth to ride out decades of economic turbulence. Success here requires moving past the patience trap. True wealth creation operates on a timeline that directly clashes with a society built on next-day delivery and instant gratification. There is a reason compound interest is often attributed to Albert Einstein. Whether he actually called it the eighth wonder of the world or not, the principle stands. Compounding isn't a financial gamble. It is an absolute mathematical certainty. This line graph illustrates the 30-year reality of compounding. If you invest $500 a month at an average 10% return, after 10 years, you will have about $100,000. By year 20, it reaches $340,000, and by year 30, it violently spikes past $1 million. This curve shows why time outweighs the size of your starting capital. The explosive growth occurs during the final stages of the timeline. Quitting early ruins the math. Reaching this stage changes the definition of retirement. It is the specific point where asset cash flow exceeds living expenses, making the requirement to work for a paycheck disappear. Getting to that point doesn't require a lottery ticket or a secret stock tip. If you actively route your cash flow, leverage the mechanics of the banking system, and trust the ruthless math of time, you stop working for money and force money to work for you.